What's up, everybody? Chris over here, founder of Pollinate Trading. Today, I'm going to show you a new algorithm, one of 3 or 4 or 5 that by now that we have released for members in the trading lab. So you're in the trading lab, you can get access to this trading algorithm. It's literally just bangs you out a signal, lets you know we know when it's about to happen, so we get prepared. But it just bangs out the signal and lets you know when it's going. So let me go ahead and show you what I got here. Okay, this is the S&P 500. This algorithm is called, well, it's based off of some research from the overnight anomaly on the S&P 500. The overnight anomaly is a well-researched data set of the idea is that the S&P 500 moves in the overnight session, where if you were to look at, like, say, a chart of the S&P 500 for, I don't know, a month, 6 months, a year, let's just do that. Hi, fingers. Nope. Let's do here we go. That's 10 minutes. Let's go 1440. Okay, and if let's turn off the extra. So the idea is you can see, especially right here. So what you see is a lot of the moves happen in, you can see a gap up, gap up, a gap up, a gap up, a gap up. And a lot of moves of the S&P happen overnight. So what we did is I got rid of the regular trading, or the overnight trading session, and all we're seeing is the regular trading session. We can go out and you can see that there's these, in essence, what the way it works is you have a market close and then it opens over here. So this one closed at 5248.75, and this one opened at 5290. So about a 42 point or so gap up on the S&P 500. And that would have been, let's say, back in March. Most notably, we're talking about this. I'm talking about this right now in August of 2024. For the past, well, month or so, maybe not month, so we had 2 weeks down, and now we're on our second week straight back up. The system has been just catching. So that's a gap to an open here. So a close at 5260 or so, an open at 5326. So a 60-point gap. This one closes down here at 5229 and then 5284. So like another 60-point gap. This one didn't work, and I don't know if we had a trade there or not. But in essence, what we're looking at is overnight prices tend to move for whatever reason, and then when you show up the next day, you're already up or whatever. And so what I did was I took all that research. So what we can do here is the overnight anomaly for the S&P 500, and you can see, you go to the Googs, and you can see that there's all sorts of, let me find the, there's a good one. Stay down in the day and up at night. Here's one from stat modeling, stat.columbia.edu. And if I can find it, trying to find the, there's a research paper. Here you go, research paper. Open PDF browser. So this is just one of those, one of the many different research papers on this. And what I'm actually going to look at here is you go to the end of the research paper and you can see all of the referenced research on the subject. This has 57 references to the ideas that they're doing in this research paper. There's other ones. I think there's like 261 academic papers on the overnight anomaly. This one, I believe, has something to do with the actual stock, and the way that one works. When they looked at here, is what usually happens is news happens, or the average retail investor gets information about something happening at the end of the day or first thing in the morning when they're reading and they're getting their information. They're not really playing the stock market hours or anything like that. So they show up and they're like, oh, I got to buy GameStop. I got to buy Apple. I got to buy this, that, or whatever. So the news hits. And by the time the market opens, the price is already gapped up. Okay. Duh. Great. A lot of the research focuses on fading that opening gap, saying that it's artificially pumped by retail and that it's not really a fundamental move. It's just, a bunch of buy orders overcrowding a bunch of sell orders. So that's kind of what a lot of this research focuses on. So what I decided to do was go and recreate the study, of course, to the idea that we get an overnight gap, right? And validate that you could buy on the close and sell on the open and get a statistical edge. So that works. That was fine. That gave me a slight edge. So, and then I recreate some of this research in Python to verify that, the way I'm doing it is the way the research was done, and that we're all looking at, I'm not just creating magic out of thin air. There's other research that's been done on it, and it's just me kind of validating the idea or corroborating the idea. So what I look to do then is I go and see if I can identify some sort of way that would give us an idea that tomorrow is likely going to gap. Now, if you know me and you know anything about what I do, it's one thing that's just kind of an obvious sort of thing that I've done forever is it's just easier to go long market, the big cap market indices. So the S&P 500, the Dow, and NASDAQ. Not something you want to do with mid caps or small caps because they don't work that way. They're not built to go up perpetually. So you have to understand certain market mechanics that exist. And this is called beta, where you just, you buy the underlying asset and it just performs with the market. So, let's do like a 1 month chart here and then we'll get a linear going back to the 1870s. So 200 and almost 50 years ago, actually more than 250, over 250 years of data. 1971, no, 150 years of data, math, shows that, yes, it pretty much since the bottom of the Great Depression in 1932 or so, even with all the dips and turmoil and issues that the stock market has had, it has gone up from a price of $4 to $5,620. So it goes up. Okay, so that's another example of an edge. Okay, we're going long because an edge exists in the market that it will go higher. And then we also have an edge that if we were to buy on the close and sell on the open, there is a slight edge there. So we kind of stacked two edges there. Now, things we need to deal with are gaps down, market crashes, catastrophic events hitting the market while we're asleep, margin or other types of ways that you can get hit from holding an overnight position like this, and one bad trade or 6 months of pain. Actually, that was about a year. A year of pain here, or so is that something that works in a down market like that in the global financial crisis 2008? Did that work? Did it work in 2020 during the March 2020? Did it work during the 2022 bear market? Did it work? So you want to look at those different things, and if it didn't, then it's very easy to identify a way to just kind of opt out of those environments. So you can't, you can't do it exactly on time. Like you can't, usually you can't just sell the exact top and buy the exact bottom and start over. It's kind of a process, right? As you move from summer into fall, it doesn't just go from, blazing hot sun all day long, late into the evening to, 20, 30, 40 degree cooler to negative degrees with snow. Like instantly, it gradually goes into it. And similar with markets, they don't instantly turn. They tend to, even if it is like a 5 or 10% move in one day, the prolonged moves that you're going to be in trouble with last a lot longer. So personally, the way I mitigate that is I use options, simple, deep out of the money, or 15 or 30 delta calls to take advantage of this. I know it's not the most efficient. I know I have a big gaping hole of places of things that I need to continue to learn, and options, option pricing efficiency is on my list of things. So, but it's nice because this is the sort of strategy that you can use with a big account or a small account. So if you use like SPY or SPX options, you put, $50, $500 to work per contract, and you're talking about the most liquid product trading at the most liquid times of any day. So it goes long on the close and buys on the open. So this is in the trading lab, and I'll start to show you a little bit about it. So we just had one. This is Wednesday, August 21st, 2024. We had a long entry. This is a 1-minute chart, the S&P 500 futures. Okay. We had an entry at, so this would have been 3:51 New York time. So the last 10 minutes of trade, we had an entry right here. And then the market closed and, goes into after hours session or whatever. And boom, we're done. Tomorrow morning at a few minutes after the open. So we wait a few minutes after the open to exit. And then we start looking for our exit conditions. So it isn't just merely buying on the market close, selling on the market open, though it can be done that way. I actually have some other tools that we've added to our strategy here to identify the type of market regime on a short-term basis, market type that gives us that best opportunity to take advantage of it. Now, it's not 100%. It's over time, it performs super well. Other times it kind of goes down. You can see we had one yesterday. So we got long again at, this one was at 57. So 3:57 p.m. And we got out this morning at 9:39 a.m. for that was like 100% gain. Now 100% gain on the options. Okay. So the futures 56, 22, 21, and then you sell at 56. So like a 10-point gain on the futures at, what is that? It's $25 per, so it's a $250 per contract, I believe, or $125 per contract. Whereas, and you had that risk of that entire contract overnight. Whereas I just go in with the calls and I just doubled my money. So if I put $100 on that, bought 2 contracts for like 56 cents, somewhere around there, I get what it was. I sold them for about $1 today. And so let's say I bought 2 contracts, $100, I sell it for 200. You buy, 10 contracts, you buy 100 contracts, however you want to do it. Again, we are doing it at the highest volume of the day. We're talking about the last 10 minutes and the first like 30 minutes of the trading day is when this trade executes. So volume, this is the most liquid product, S&P 500 in the market. And it's trading at the most active time of the day. And the reason we're doing S&P and not individual stocks or whatever, because we have same day expiration, 1 day to expiration, the most products to trade too. So you could buy SPY, you could buy VTO, you could do all the any, MES futures, ES futures, any of those that you want to do, depending on what accounts you're using, and get yourself that. So let's go over the result. First of all, I coded this up into so I did it in Python, and then I did it into trading view here in PineScript to confirm it was the same, because those two are just like super quick. And then I actually built the algorithm in multi-charts so that it could just plug into my broker, and I don't have to host the Python or anything like that. I just use another platform. So it worked in all three. The downside here of TradingView is it only gives me trades it only gives me data because it's a 1 minute chart. It only gives me back to June. So, but in the last, so that has been 25 trades, 19 winners, 6 losers. We have a Sharpe ratio. This is 30-day Sharpe. So you multiply that by 12 and you get yourself the your 2 point something Sharpe going into the data. And again, so profit factor of 5.5, 76% win rate. Pretty nice. It is what it is. Okay, so here's going back like 10 years or so on that chart, or on that same trade. And this is a $50,000 account using one S&P E-mini, the ES futures contract to trade it. We have the equity curve here up over $100,000 in profit in like, I don't know, 7 years, maybe it's 8 years. I'm not sure. It doesn't, I don't know. It looks like somewhere around 2017. And then there was a drawdown of 20% here in 2019. There was a drawdown. So probably it was just a down week or two. And that's also why I like to use the options, because with options, if it is a gap down, the option just goes to zero. It doesn't, it isn't infinite. We're not infinite, but it isn't, it can't chew up all my margin. Same can be done with just the regular stock. But so you can see that it had a 2018 to 2019 period where it kind of got a little boring. And so what actually we do here is we use a regime filter to keep us out of this thing here. And it turned out that Russell short in that period, I believe, or maybe it was long, is quite a nice one. And also, if you do a pairs trade on this with a long S&P short Russell every day, it smooths this out quite a bit. But so there we go. Here's our numbers. 55% win rate over, so it's long only. You can see there's no short trades. Over the course of, again, like I said, this is like 7 or 8 years of data. So some periods, looking at this, it's been really good since 2020, let's call it 2020. Well, I know when that was. That must have been like October 2022. Or no, probably somewhere in 2023, maybe March 2023. Anyway, it's just been fire ever since. But you can see it in 2020, in 2021 to 2022, it was pretty great. Even through the bear market, it just, the 2021 bear market, it just didn't do much. It didn't hurt you much, but it didn't do much winning. So, you throw a regime filter on it, or we switch the asset to a different one that has a similar performance. So again, using one S&P futures contract with a $50,000 account, it's at a 20% drawdown. If you had a $100,000 account, that'd be a 10% drawdown. If you had a $10,000 account, probably blow up. Profit factor 1.22, which again, we're looking at, this is unfiltered with the regimes. This is just using micro regime. So the last, basically we're organizing the day intraday by different times. And then we tend to get some sort of suggestion. That's 2% a month. Monthly rate of return, 2%, trading this 1.95%, I should say. So you're looking at, if you can compound at 2% a month, you're doing pretty great on your money. That also includes $25 of slippage and commission. There's nothing in commission. I just put $25 for slippage. That way it's just one calculation. Let's see here. Return on capital, 415%. I wish I don't have the that number. Total number of trades, 974 trades. Again, 55%. Average winning trades, $848. Average losing trade, $891. That changes because the cost of the contract continues to change. Average 33 minutes in your trades of open market time. And then, here's the Monte Carlo. Yeah, so the Monte Carlo simulation, largest drawdown, $54,000 off of its equity peak here. So it went from 80 down to 20. So yeah, there is some risk. There is some risk on this one. And as long as we have the implement our filter regime, we work our way through it. But that's the whole point of this, right? Is we want to know what we're doing, want to know what we're dealing with, and want to trade it. And so just give you a shot. Here's the overnight anomaly. We went live with it August 14th, so it's been live in the lab algorithmically. I was pasting these trades for the past month in there, and now we have the algorithmic signal. So today we had SP SPOO's overnight anomaly long alert at that time, and so you get that alert happen, and you just put your trade on. That's the way we do it. So it's going to be built out a little bit more based on user demands. Right now, it's mostly just our most active traders. Actually, it's not just our most active traders. It's a couple of our most active traders, and it's also a couple of folks who are just show up for the last little bit of the day and show up for the beginning, and they just do the SPX options and have actually been kind of crushing it themselves. So that's what it is. If you want to join us here to get access to this and the other ones, it's pollinatrading.com. Here, let's go to the lab. pollinatrading.com/lab. And we have all these. This is the overnight anomaly system right here. We have the Swing Beast momentum system that you can get access to, and the NASDAQ swing system, which is currently in a beautiful, beautiful trade. Again, this is back to like 10 years back on it. You can see it's really started to come into its own here, similar to this is the overnight anomaly system, a little bit shorter time frame. And then this is our swing trading system. You can get access to all of these, plus our live chat throughout the day, and join us through any of these other methods. If you have any questions, reach out, come check it out. pollinatrading.com/lab. I love each and every one of you guys. And yeah, bye.